Good morning, everyone. Hope everybody's keeping well and following the news that's coming out. Geez, there's a lot of news in South Africa, not good news, hey? Right, let me get my presentation up and then we'll talk about what it is that we're going to cover this morning. All right, I'm hoping everybody can see that. So a couple of things just to mention maybe up front. We're going to focus on South Africa for this morning's discussion. We'll talk about some of the global developments, which are obviously critical. Global inflation, global interest rates, global growth, all of those factors. We'll discuss them briefly, but we're not going to go into a huge amount of detail. The feeling is that there's a lot unfolding in South Africa that we need to pay attention to, and we maybe need to put that in context. So that's going to be the emphasis for most of this discussion. As usual, during the discussion, there is a Q&A box that is open. So if you want to post questions, please feel free to do that. As I go along, I'll see if I can answer any of those questions. Otherwise, at the end, if there's a bit of time, we can deal with some of that. And if the questions relate to other topics, no problem. Either I will ignore it because I don't know what the answer is, or we'll deal with it in another context. But please, you don't have to ask questions that are directly related to the charts that we put up. Also, you have to stay on for the whole thing to get CPT points, and a recording will be available. Also, a copy of the charts will be sent to you. So please don't stress about that. Yeah, I think that's all about the kind of preamble. So let's dive into the key discussion. And obviously, the focus, there's a huge amount of focus on those three things that I mentioned. Inflation around the world, phenomenal focus, trying to understand where's the peak of inflation. We think that most countries are close to the peak or at the peak, but there's still a lot of debate around that. And obviously a lot will depend on what happens to the oil price and to some extent, I guess, food prices, but it is highly dependent on the oil price. So that's the one area. The other area is how do central banks respond to that? A lot of central banks have put up interest rates already. Others will continue. The focus there remains the US Federal Reserve, which meets at the end of this month again. Expectation, they'll put up rates another 75 basis points. And other central banks will continue to hike rates or start to hike rates. The ECB is expected to start to hike rates this week. 25 basis points. Believe it or not, they haven't increased interest rates at all, even though their inflation rate is up at the 8% level. So they're expected to start that process. And other countries will continue to hike rates, undoubtedly. South Africa, we think, will continue as well. This week, tomorrow, we'll find out what the Reserve Bank is thinking around our interest rates, probably 0.5%. There's some discussion about 75 basis points in South Africa. So we are in the midst of interest rate hikes. And then the third topic, which feeds off all of that, is what does all of that do to the real world, to the real economy, to overall economic activity? If you look at the chart on your screen, you can see that in terms of world growth, the world economy was the biggest it's ever been in the first quarter this year. Now, not every country has obviously recovered fully from the effect of COVID. Most countries have now. South Africa has. Our first quarter GDP was on the high side, surprised on the high side, and our economy is now effectively the biggest it's ever been. The US has been the biggest it's been for quite some time. In other words, it's fully recovered. Europe is fully recovered. China obviously fully recovered. So there are a lot of economies that are at a record high. Others are still in the process of recovering, but the world has done okay after COVID. And obviously the concern right now is how does the pickup in interest rates start to impact these economies? Does it push economies into recession? And there's a risk that some economies will go into recession. I don't think that we're going to have a global recession. Global recessions are actually quite rare. Obviously, we had that during the COVID crisis. We had that during the global financial market crisis. But if you look over time, that a global recession doesn't really occur if you're simply putting up interest rates in order to control inflation. It tends to occur if you've got a major shock to an economy. COVID was a shock. The bursting of the housing bubble in the US was a shock. So if you had that sort of event, yes, then you could have a global recession, but I doubt we'd have one now. This seems more of a traditional cycle in that inflation has got out of control and you're putting up interest rates in order to control that. And hopefully that is reasonably successful. So I don't think we end up with a global recession, but I do think we end up with some economies going into recession, and there's a risk the US has a recession. There's certainly a risk that parts of Europe have a recession. South Africa, I think, is going to flirt with recession. So I think it's going to be evident and increasingly evident over the coming months. So those are the sort of key focus. There's a question, could interest rates in South Africa triggering a housing bust and deleveraging? We think not. And the reason why we think not is because, first of all, our house prices are not elevated. I was looking at housing prices in South Africa, just residential housing compared with inflation over the last 10 years. And house prices have underperformed inflation over the last 2 years. It's actually been a bad investment. There are many other investments where you would have got a better return than inflation. In fact, if you just pretty much put your money in the bank, you would have beaten the housing market. So housing hasn't done well. Housing hasn't been a great performer. Obviously, that does vary quite a bit from town to town, city to city, and within the town, suburbs. So there are big differences. But overall, no, it hasn't done well. And it's not doing well at the moment. There tends to be an oversupply of housing in Johannesburg, which is dampening down prices because a lot of people have exited Johannesburg on their way to Cape Town and other cities. So house prices in Cape Town not doing well. Also, there hasn't been excess demand for mortgages. So we don't think that the mortgage market is massively overinflated and that you're going to push up rates and really hurt the housing market. I don't think that's likely. Equally, of course, I don't think the housing market's going to boom because in order to get the housing market a lot more vibrant, you need jobs. And we just don't have that. So I think our housing market is resilient, although desperately weak. Other countries, yes. I mean, the US definitely has a housing bubble, and I think you're going to see prices come down sharply there. China been living with a housing bubble for a considerable time, and there's definitely a weakening going on in China's housing market. It's not what it used to be. So other countries, yes, there are clear risks. Somebody says they're logging in from Mozambique. That's impressive. Welcome from Mozambique. But I don't think our housing market is that vulnerable. Okay, so I digress a little bit. So the global inflation, everybody in the world's got an inflation problem with a couple of exceptions. The exceptions the key exception, I guess, is China, where they don't have an inflation problem whatsoever. They've got fairly low inflation numbers, but most countries, certainly most of Europe, most of North America, most emerging markets have an inflation problem where inflation has moved up very sharply in the last 2 years, well above any sort of target. In some countries, it's become quite excessive. And in most countries, the cause of inflation has been the energy sector and the food sector. And in most countries, outside of energy and food, there isn't actually a huge amount of inflationary pressure. The US is a clear exception and an important exception because there the inflation problem has broadened much more than simply saying this is food and fuel. They've got a housing inflation problem or a rental inflation problem, and they've got all kinds of other areas where there's significant pressure. So the US has broad-based inflation, and therefore that's going to take a considerable effort to bring that under control. In other countries, that hasn't manifest fully yet, but if you allow inflation to stay at these levels for a considerable time, it will result in broad-based inflation. And the reason it would do that is because of the response from wages. And you can see the wage response in South Africa, where unions are asking for double-digit wage increase, whether it's SARS, whether it's the motor industry. Most unions are going to be trying to negotiate at a double-digit wage increase. Obviously, I don't think that's where we're going to settle wages, but it clearly could end up with a much higher wage rate than we've been having in the last couple of years. And obviously, once wages go up, can lead to broad-based inflation. So most central banks around the world are very aware, acutely aware of that, including the Reserve Bank. And so they want to dampen that down. And the only thing they can really do is push up interest rates. And you can argue that the inflation problem is mostly a supply side issue. And in South Africa, it certainly is relevant. And that putting up interest rates is going to do very little. And that's 100% correct. If you put up interest rates in South Africa, it's going to do absolutely nothing to bring down the petrol price. You put up interest rates, it's not going to stop electricity prices going up, etc. So does that mean central banks shouldn't put up interest rates? No, because of the second round effects, of the risk that this broadens out. Also, if central banks don't put up interest rates, what is the message they send to companies, to trade union, to a household? If central banks don't put up interest rates, the message is we're okay with inflation being higher. And as soon as that's the message, prices start to reflect that message. And before you know it, you have got broad-based inflation. So central banks have to send a message. And that message has to be, we want inflation down and we're going to put up interest rates. And yes, it does hurt. And yes, it can put economies in recession. And yes, it might be less effective in bringing inflation under control. They're still going to do it. So far this year, I was counting up about a week ago, so it might be a bit out of date, but there are 44 countries at least that have put up interest rates around the world. And others will join. And this excludes the European Central Bank, right, which represents a whole lot of countries. And the European Central Bank will put up interest rates this week. So you've got broad-based increase in global interest rates, which I would say is only really at the start of those interest rate hikes. It's not as if we are mostly through the interest rate hikes. That's not the case at all. Most interest rates have been extremely low and will be moving up fairly aggressively. The other thing that's come through as a very clear message is that central banks are going to front load interest rate hikes. By that, I mean they're going to go more aggressive in the short term, get rates up, because they feel that rates have been exceptionally low and well below inflation. So they don't want to wait around to move rates up. They want to move rates up quickly. And then when they've got them to what they regard as a neutral interest rate, then may ease off, maybe pause, maybe assess what the impact of the interest rate hikes are on the real economy. But in the short term, they're going to keep being more aggressive because they're behind. They're behind the curve. They've got to catch up. Certainly the US is behind the curve. South Africa, not so much. I think we reacted quite early, so I don't think we're in quite the same position. But nevertheless, the message coming back to central banks, when they go and sit around a table at the Bank of International Settlements, the message from the Bank of International Settlements and from the IMF is front-load interest rate hikes. Don't wait around. And that's what I think central banks have been adopting, including the South African Reserve Bank. The other thing to be very aware of is that while you've got this elevated inflation everywhere in the world, there's a massive base effect that's going to help inflation in most countries. Almost every country is going to benefit enormously over the coming months from a base effect in energy prices. And I want to illustrate it just by two charts related to US gasoline prices, US petrol prices. Now, I see there's a question on gray listing. We'll come to that a little bit later. I don't want to talk about gray listing right now. So if you look at US gasoline prices, right, that's been a key factor in the US inflation. As I said, it's not the only factor. And petrol and oil have been a big factor in global inflation. And you can see the rate of increase that the US is dealing with at the moment. It's in the order of 50%. So if 50%, you've got a category which is fairly sizable in anybody's basket. You've got a category of consumption where the price hikes are 50%. That's clearly going to put upward pressure in any country. Now, the oil price has moderated a bit. It hasn't moderated dramatically, but here's the power of the base effect, and that is that the longer you stay, let's say oil price at $100 a barrel, the longer you stay at that, the more you will start to get a 0% increase in oil inflation, because when you look back a year, the oil price was $100, and you get that massive base effect where you go from plus 50% to 0%. Now, in the US, that's going to start to happen next month. That base effect starts to kick in next month. And I want to show you what that looks like. So if you take the gasoline price in the US, which is just below $5 a gallon. So if you take the gasoline price where it is and you keep it where it is for the next 12 months, this is what gasoline inflation will look like, right? So you don't have to have the gasoline price come down. You just have to have it stay exactly where it is, and you're going to get this base effect. And what it means is that an item that was going up by 50% is going to be going up by 0% or even negative. And what that will do is it will bring down the whole inflation number, the headline inflation number. And you're going to have the sense that inflation is rolling over in just about every country, including in South Africa. Now, our base effect is a little bit delayed. And the reason our base effect, like I'm showing you for the US, the reason our base effect is delayed is that we decided to subsidize the fuel levy. So remember, the fuel price was going to go up dramatic. Government stepped in and said, we'll provide a R1.50 subsidy where we will delay that for 3 months. Then that 3 months passed and that didn't really help. And they said, okay, we'll delay it effectively for another 2 months. But by delaying the petrol price increase, what you're doing is you're delaying the base effect because you're living with a higher price for longer. Maybe it doesn't spike up as much initially, but you don't get that favorable base effect as quickly, if that makes any sense. Which means we're still going to have this base effect that you've seen on the chart. Every country is going to have this base effect. Ours is just going to be a bit delayed and will be more evident in the early part of next year. But critically, this starts to happen in the US next month, which means in all probability, the current inflation rate in the US, the 9.1% that we saw come out last week, that's probably the peak. And most countries, you'll see inflation start to roll over. So does that mean that central banks then stop putting up interest rates? Not at all. They're going to continue to put up interest rates, even though inflation's rolling over, because they're going to want to be sure that when you get that roll over, then inflation ultimately does go back to the target and that it is inside the target. But it's going to be an important psychological factor that says you passed the worst, and that you can see that inflation's getting better, and you can see that central banks are then going to be more moderate or more considered on how they adjust interest rates. And I think for markets, that's quite an important signal. We're not there yet. We're about a month away from that in some countries, in others slightly longer, but it's an absolutely critical factor. Okay. The other thing to be aware of in terms of growth is that globally, confidence has been decimated. So all of these events over the last while, if you put them all together, so if you look at the COVID and the difficulty in dealing with COVID, if you look at inflation, if you look at the Russia-Ukraine war, and obviously the higher oil price, if you look at the higher interest rates, you put all of those factors together, it is undermining confidence everywhere in the world, right? It's not just the interest rate going up that's going to start to do more economic damage. It's the weakening of confidence. And when confidence falls, people hold back. They don't invest enough. If you're a company, you start to hold back investments. If you're a household, you become nervous, you don't necessarily buy a house, etc. So this loss of confidence is critical. And I just want to show you how bad it's been around the world. So this is the global confidence index, and you can see it's moved firmly below the zero line. And every time it's below the zero line, we pay attention to this. It doesn't mean that it's a recession. It just means that confidence is weak, but it's gone meaningfully below the zero line. And you can see the last two times when we had a global recession, how weak confidence got. So we're not at that level, but clearly we're at a level of confidence that will be worrying and has signaled that the economies are going to weaken. And so it's very, very unlikely that the global economy is going to accelerate, if you like, while confidence is this weak. That's incredibly unlikely. It's much more likely that that first chart I showed you, GDP at an all-time record high, that you're going to see a moderation in economic activity while confidence is this weak. As I say, it doesn't mean a global recession, but it certainly means a global economic slowdown. From our perspective, the key question is that priced into markets? Is this slowdown, is this lack of confidence, is this priced into markets? And you can't be sure, right? But you would say it's mostly. It feels like it's mostly priced in. Markets have come off considerably. And it depends on the country you're in. I would argue that the US valuations are still a little bit demanding. US earnings are still a little bit inflated, probably have to come off a bit. But I think most of the pain is reflected in markets. So you're going to find asset managers increasingly starting to eye equity markets with an option to, is this the time to go back in? And each one will make their own decision, but you are getting closer to that point. Now, that doesn't mean that economies have felt the full pain of the slowdown, not at all. That pain is still ahead. But obviously, markets tend to look forward, and fund managers want to invest when things are at their worst. So the fund management community is eyeing these markets and deciding, should I be more aggressive? And as I say, from my perspective, it's getting close. Perhaps it's not quite there. You've probably got some shock bad news still ahead. But I think most of the pain is reflected in the price already. So when we look around the world, confidence looks bad, right? So look at consumer confidence in the United States. They have two measures. This is the University of Michigan confidence. The number you see on the screen is the lowest ever recorded, which is exceptional, right? And it's been aggravated by the inflation problem, and obviously now the interest rate hikes. And people in the US take inflation very badly. In South Africa, we focus on it, but we kind of a little bit don't understand what the big deal is. There are a lot of people who, well, so what? Inflation's 5% or inflation's 8%, so what? In the US, they understand it's an absolutely devastating effect, and their confidence reacts quite strongly to a sustained increase in inflation. And so you can see confidence has come off very sharply. If you look at confidence in Europe, what's consumer confidence look like in Europe? Pretty much trashed. It's back at the level that existed during COVID. And that would be a firm signal of a region going into a recession. And again, for the same reasons. They haven't even started to increase interest rates, and look where their confidence is. Again, it reflects inflation. The developed markets are very sensitive to an acceleration in inflation because you're constantly living with an inflation rate of 1 to 2%. And it seems like that's the norm, and it has been the norm. And then suddenly you find inflation at 7, 8, 9%. That undermines your confidence very dramatically because your wages are going up nothing like that percentage. And so you realize that you are worse off, considerably worse off. There's a question, is global weather playing a part in confidence? I think it is. I think there's a lot of more information now around global warming, the impact of climate change. Of course, you don't always know. Every time there's a weather event, you're going to have analysis that says, oh, this is global warming. And that's not the case, right? Because we've had in the past decades of lots of massive global weather events, and we didn't ascribe them to global warming, and we'll do that now. So that relationship is going to become quite blurred. But there's no doubt that there is an impact going on, and that the world is warming up, and that it has consequences for weather and other issues. And yes, I do think at the margin it's having an impact on confidence. What we are looking at is, when you break down the confidence numbers, there are two elements. The one is what's called the present situation. How confident are you about things right now? And then the longer term expectation. How confident are you about the future? And those are two important differences. And where we've seen the sharpest fall off is in the present index. In other words, people are very unhappy with things now. You haven't seen quite a sharper fall off in the expectations outlook, the longer term outlook, which would suggest that climate change is a factor, but it's not a complete devastating factor in terms of confidence at this stage. Doesn't mean it can't become, and doesn't mean that if it's not dealt with more effectively, it becomes a very key factor. But I would say right now, the emphasis is on broad-based inflation and higher interest rates. Our inflation numbers come out to 7.4%, I see. Thank you, Gregory, for updating us, 7.4%. I think that is about, might be slightly ahead of expectations, slightly. But most people are thinking, we're saying it will go over 7%, get close to 7.5%. And obviously a key reason here is the energy effect. And that was, I think, and obviously you've got food inflation in South Africa, but you've got some big petrol price increases that are still coming through. And clearly that will be factored into the Reserve Bank's decision tomorrow. I think they would have been expecting the number to move up sharply, so I don't think it will be a shock for the Reserve Bank. But clearly we are also experiencing our own surge in inflation, just with a bit of a delay compared with some other countries. And then if you look at our confidence number, this is our consumer confidence. Now, instead of showing you the total consumer confidence, this is the confidence amongst people aged 50 and older. And this confidence is the lowest ever recorded. Now, generally, older people have lower confidence than young people, right? If you look at most confidence surveys, older people lack confidence compared with younger people, and it's got to do with this concept of ignorance is bliss. So when you're young, you're just ignorant. You don't know what you don't know. You don't know that you should be concerned, and so you're not concerned. And so you carry on blissfully. And so that reflects in your confidence. And as you get older, you become jaded, cynical, and you recognize that the world is a bad place and that your confidence reflects that. The problem is this confidence amongst this age group is exceptionally weak. This is weaker than during COVID. And this age group is important because it represents a lot of spending power, and it represents a lot of investing power. And in our industry, most of our end clients fall into that category, right? And so we've got to be sensitive to that idea that a lot of people we're talking to have an exceptionally low level of confidence compared with the average in the country, and the average is not good. And by global standards, you would say that people age 50 and older in South Africa are exceptionally negative. And I think we need to be mindful of that. We need to be empathetic towards that. People are very nervous, very unhappy. It's not as if you can provide a huge amount of positives to offset that. There are a lot of negatives around, but I think if we just empathetic to that, it helps a considerable amount. Okay, so confidence everywhere in the world's weak. Interest rates everywhere in the world is going up. And so global growth is going to slow, and some economies are going to go into recession. That's pretty much the story. We think most of that is priced into the markets, not all of it. And so there is still some risk to the downside. But you get into a point where if you have some more really bad news, many asset managers will be using that as a signal to go into the market, looking for that point of maximum pessimism. I don't think we're at the point of maximum pessimism. I think that's still ahead, but that's what people are starting to debate. And I know within STANLIB, that's our debate. Our debate is not about how bad the numbers are. The debate is this an opportunity to go into the markets? And obviously each franchise makes up their own mind. So let's talk about South Africa in a bit of detail, in a lot of detail. And I need to warn you up front, this isn't good news. I've got some good news right at the end. It's like dessert. I've saved it till the end. It's not overwhelmingly good news. It's a couple of better indicators, just to soften the story, I guess. And they are meaningful, but the overall situation in South Africa is bleak and it's got worse. And I think we need to be aware of that reality. And therefore, when we engage with clients, we can explain this, put it into context, and maybe that helps a little bit. I don't know. So our economy is the biggest. Technically, our economy is the biggest it's ever been, right? And GDP in the first quarter, adjusted for inflation, the biggest it's ever been. The growth rate is not impressive, and you can see that in the slope of the curves. But it's recovered. We recovered from COVID. Obviously, we didn't recover employment, and that's critical. Our employment is still about 1.5 million jobs below where we were, but the economy is the biggest it's ever been. And there are areas where the recovery has been better, say retail sales has held up better. And there are areas where it's lacking. Mining production is lacking, and that's very sad. Electricity production, shocking. So it's not as if every part of this economy has fully recovered, but the economy in total has. Now, are we going to see weakness going forward? And my view is yes. And are we going to have negative quarters? Yes, I think we will have negative quarters, and we may well have a technical recession. So we've got to recognize that all of these factors, inflation, interest rates, confidence, electricity outages, they all take their toll, and they're all undermining the well-being of South Africa, and they all could result in weakening economic performance, and I think that is very likely. Obviously, the government's aware of that. National Treasury, the Reserve Bank's acutely aware of that. And the Reserve Bank knows that as they put up interest rates, they're going to damage this economy more. They know that. They acknowledge that. But their fight is against inflation. Their fight isn't against economic growth. If you talk to them about economic growth and you say, yes, but you're just hurting the economy, they will respond by saying, well, there are other areas of policy that need to help our economy, and they're not doing their job. And that's 100% true. You can't blame the Reserve Bank for everything. There's a whole lot of policies that need to be in competition, industrial policy, state-owned enterprises, all of those things are lacking. And if you want to grow the economy, you've got to fix those problems. Don't say to the Reserve Bank, no, you mustn't control inflation because you're going to hurt the economy. They just won't accept that. It's not their job. So the National Treasury is aware of this. They talk about it, but they're also frustrated because they recognize that a whole lot of other government departments have to do their job in order to get this economy going. All right, so let's have a look at some of our components of growth. Now, a couple of things that stand out for me in terms of our growth dynamic. The first is we are a consumption-based economy. We like to think of ourselves as a production-based. And certainly the government likes to talk about us as if we are a successful production-based economy. That's simply not true. We've systematically become a consumption-based, and we've systematically importing more of the goods we consume. And that's sad, but that's our reality. And you can see that in the difference between shopping, retail sales, and manufacturing. And that you've seen this chart before. That difference continues on. Manufacturing remains under pressure. There's no revitalization of the manufacturing sector taking place at all. It's losing further momentum. Government keeps talking about the need to promote industry and promote domestic production. It's just not happening. Yet the part of the economy that holds up better is basically shopping. Consumers consume most of their income, if not all of their income, and that keeps the shopping sector reasonably intact. The growth rate is not spectacular, obviously, in shopping. It's in itself fairly weak, but it has handsomely outperformed most other sectors. And this divergence is not helpful. It's not helpful if you want to grow your economy fast. It's not helpful if you want to create jobs. It tends to result in countries being highly import dependent. And so it's not a dynamic that we should be embracing. We should be doing a lot more to encourage the productive sector. And that includes things like construction, mining. But when you delve into the production sector of this economy, it's very clear that that's not going to work until you've got better infrastructure. The productive sectors, construction, mining, manufacturing, critically need infrastructure, electricity, roads, railways, harbors, all of those things where we've got major deficiencies, that hurts our productive sectors. And so it shouldn't be a surprise, but it's very clear that if we are able to start to implement better infrastructure, then we can expect an improvement in production or the productive sectors, and that will help us in terms of job creation and in terms of the rate of economic growth. We're just not doing enough about it. The other area that's incredibly disappointing from our perspective is the mining industry. So look at the volume of mining production. Again, you've seen this chart, but it's been updated. And it's very clear. If you look at the last, let's call it the last year, that index has been moving down on a trend line basis. Now, before COVID, you would say that mining production was fairly stagnant. It was holding a level, so it wasn't declining, but it wasn't increasing. And the mining industry was stagnating in total, right? Some doing better than others, but in total stagnating. Then we come across the commodity, the most recent commodity boom. And with that most recent commodity boom, you would have expected, or you would have hoped to have seen mining at least hold on to current production or invest some more and accelerate. Not dramatically, but maybe use that as an opportunity just to up the output. Instead, we've gone in the opposite direction. So the mining industries derived this benefit, yes, in terms of revenue, and they're paying taxes, and it's helped our trade balance. But in terms of volume of production, it's gone down. And the mining industry has lots of projects they want to invest in. It's not as if the mining industry is saying, no, we're not investing. There are things they put on the table that they are willing to invest in. But they keep saying that unless government changes regulation, unless government makes it easier to invest, unless government deals with the port capacity, the railway capacity, there's no point in investing. So the ball is definitely in the court for government to make a difference here. And again, government's aware of that. We've not so long ago had the mining in Durban. Government was made very aware of the limitations in the mining industry. But unless there's a sense of urgency out of government to implement and make changes, it's very difficult to see this economy being vibrant and to see fixed investment taking place. So I would put the blame here squarely on government. And I'll talk about that later on in terms of where the president's at and electricity, etc. The other thing is that we're very, very clear is that it's hard, it's impossible for an economy to be vibrant if your electricity distribution curve looks like this. In other words, this is the amount of electricity that is available for distribution. It's monthly data, and obviously it varies from month to month. And within the month, you can imagine that it moves around quite a bit. But it gives you a sense of the trend. And the trend's been there for 10 years or more. The trend is firmly established. And that is we're simply unable to produce the same amount of electricity we did a year ago. Now, I'm not aware of any country in the world that has a high degree of prosperity, a high degree of growth with declining levels of electricity distribution. Now, this electricity is not just Eskom, hey? This includes all the other producers, not that there's a huge amount, but it's the full production of electricity in South Africa, and it is also adjusted for imports and exports. And it's something I think we don't really talk about that much, but South Africa imports and exports electricity. So all of that is included. So this is the net available distribution in total. it's telling you that if this continues on as a trend, it's not possible for South Africa to achieve a high level of economic success. It's just not going to happen. And so in order to try and turn this around, this becomes the critical factor, and we are aware of that. Obviously, nothing's happened. Government talks a lot. We keep hearing this promise about some big announcement from the president. I think we'll get that announcement. Whether it satisfies participants, I'm not sure. I think you're going to end up with an announcement from the president that sounds okay, but immediately you're going to say, yes, okay, but you've got to implement those changes. And that's been the problem. It's not been about the policy. It's not been about what's been written on a piece of paper. The problem has been an unwillingness and a lack of implementation. And it feels to me that we have to constantly get to this point of outright crisis, this point of catastrophe, before government responds and says, okay, let's implement something meaningful here. So it's probably got to get worse before it gets better. And that's a terrible way to run a country. It's a terrible way to run anything, run a household, run a business, where you lurching from one crisis to the next. But that's how it feels in South Africa. And I think we're at the point of an energy crisis, and maybe that energizes government to do something better. But it's very clear that unless we do something with a high degree of urgency, we're going to struggle to turn this economy around in a rising interest rate environment. So that message to me is abundantly clear. The other area that we are desperately lacking is fixed investment in general. Last year was the lowest ever recorded. The data actually on this chart only goes back to 1970, but the data that South Africa has goes back to 1946. This is the lowest level of fixed investment ever recorded in this country. And unless you're investing in a country, you're just not going to be prosperous. It's like anything. It's like being in a business. It's like an individual. Let's say an individual wants to be successful, but they don't invest in themselves. How are they going to be successful? What's investing in yourself mean? Getting an education, maintaining your health, making sure that your skill levels are being updated, whether it's computer skills, new technology. Unless you invest in yourself, you're just not going to be successful, right? And if you look at a business, I've never seen a successful business that doesn't invest in itself, put money back into the business all the time. And the same applies to a country. Unless a country is investing in itself, it's just not going to be successful. This level of investment is pathetic. It is a country that is not willing to invest in itself. And if that's the case, again, you're going to end up saying this is desperate, this is dismal. This is government and private sector investment. Again, government's very aware of these. These numbers are spoken about. The forums I'm in, government's National Treasury, very aware of this. Government keeps talking about the need for infrastructure, private-public partnerships, all of those things. Keeps promising that we're going to do something about this. You keep coming back to the same obstacle. The obstacle is implementation. And right now, we're going through this increased political turmoil, right, as we head towards the elective conference. And the more we have that political turmoil, the more it feels that these real substantive things are not being focused on. All righty. So at this stage, you should be fairly depressed. I keep saying if you're not depressed, you don't understand the content. And then just to finish it off, as if you're not fully depressed, employment is 1.5 million below where it was before COVID started. And that's, again, unless we're willing to create jobs, and jobs come from investment, this economy will be sluggish. Now, there's an element of this that I think is important for the asset management industry, and I just want to highlight that. And unfortunately, it's another big negative, but it's important that we understand this, I think. When you look at GDP per capita, income per capita, it's stagnating or even declining. So when you look at South Africa, because we've got the sluggish GDP, the sluggish economy, we've still got a high population growth rate, but the economy is quite stagnant. That means income per person is stagnating in real terms. And you can imagine if you translated this into dollars, what it would look like, because obviously the rand's been weakening against the dollar. So our international purchasing power is diminishing. Now, That means more and more South Africans are going to be trapped in South Africa. You can't afford the world around you. That's the message that comes through. But from an asset management point of view, there's something I want to highlight here that I think we need to be aware of. And look at where we rank on various tables. And I just want to refer you to the second line on this table, the share of world household wealth sitting in South Africa. Now, it was never brilliant. At its best, it was around about 0.5%, all right? But if you look at the latest number, that has dwindled to 0.18%. South Africa's share of global household wealth is 0.18%. And if I look at our policies continue to focus on how do we distribute wealth better. And you can understand why. We have a massive Gini coefficient problem, an inequality problem. But we have no policies that focus on how do we grow our wealth. And if we're constantly worrying about how you distribute wealth, but you don't spend an equal amount of time worrying about how you grow your wealth, you end up focusing on distributing a smaller and smaller pie. And that message is just not understood. We keep thinking that we're wealthy. South Africa's not wealthy. The rest of the world's wealth has moved on. Their housing market has been buoyant. Their equity market has been buoyant. Their incomes have risen. Their employment have risen. The world has moved on. And we represent 0.18%. Now, where does that mean we fit in a global scale? We are ranked 101 out of 168 in terms of household wealth. So would you say that South Africa is a wealthy country at a household level? Absolutely not. We rank 101. We would be ranking among the poorer countries in terms of household wealth. So the message is two things. One, we have to start to focus much, much more on creating wealth. That starts with job creation, and it starts with investment. That's where you've got to focus in order to start to change this dynamic. The second thing we've got to understand is that the longer this wealth stagnates, the more we are going to continue to stagnate. Let me explain that. So the rest of the world embraces constantly improvements in technology, improvements in medicine, improvements in computers, improvements in all kinds of things, right? But that technology is expensive. And if your wealth is under pressure as a country, you find yourself unable to afford these developments, which means the rest of the world embraces the new development. It moves on, it becomes more competitive, and we tend to then stagnate because we can't afford those new developments. So there are many dynamics to the stagnation. It's not just a question of, well, we're stagnating, we're not growing, and oh, gee, it's not good. There are many really serious problems that go along with this. All right, let's move on to inflation quickly. I'll chat about our inflation, and then we'll look at the dessert at the end, which is a couple of positives. And then we'll see if there are lots of questions, some great questions. I hope I get a chance to have a look at them. All right, so our inflation problem, as I said, is mostly food and fuel. That remains the case. I haven't looked, obviously, at the latest inflation data, but it is mostly fuel and food. Now, those pressure points are significant. If you look at agriculture inflation, it sits at 19%. And the last time we were at this sort of level, we had food inflation of 11%. So this on its own is telling you that there's upside pressure on food prices. Food prices have already moved up, but there's further upside pressure in the system. So we could still be hurt by higher food inflation. If you look at our petrol inflation, it sits at around over 50%. And as I say, we have developed a base, but we're not going to notice that base effect for a couple of months. So it's at least a positive over the medium term because the number will start to plateau out and then come down. But in the short term, we've still got some petrol price increases that are going to have to be factored in. So in the short term, there's definitely additional inflationary pressure, which means that South Africa's inflation rate is going to stay high in the short term. There's another element which I just want to flag, and that is the risk of imported inflation. Because we import so many goods, and because international inflation is elevated, we run the risk of having to import more inflation. And one item that's already in my mind showing that is the inflation rate for household appliances. So think of it as fridges, freezers, microwaves, those sorts of things. That inflation rate not long ago was sitting at basically 0 to 1%, maybe 1.5%. Very little inflation going on in household appliances. And globally, there was no inflation going on in household appliances. That number's now, before the latest inflation reading has gone up to 5.9%. And what does that reflect? It reflects a weaker currency plus international prices moving up. So at the moment, our inflation is food and fuel, but there's just an element that we've got to be careful about where imported inflation can start to come into our numbers, and the Reserve Bank's going to pay attention to that. And therefore, we can expect further interest rate hikes. So this is what my inflation forecast looks like. Obviously, this number was done before the latest inflation number, where we were sitting at 6 point whatever, and now we've gone up. On my chart, you can see I was looking for about 7.5. It's at about 7.4%. But you can see that the forecast keeps inflation elevated for a couple more months. In other words, inflation is expected to stay above 7% over the next couple of months, and then have a look at it in 2023. That's the base effect. And that base effect is mostly in energy, and to some extent, we hope food prices. And then inflation comes down and it ends next year at 4.5%. And I think by the time we get to the end of next year, we'll be talking about interest rate cuts. And it's very possible the Reserve Bank will have already cut interest rates by the end of next year. Sounds weird, but I think that's where we're heading. So this base effect is very powerful, but we've got to see it, right? It's all very well talking about it, but it's got to start to reflect in the numbers. And then I think the dynamic around inflation will start to change, and the feel around inflation will change. As I said, the US, I think, is just about there. South Africa's a couple of months away. In the meantime, obviously, interest rates are going to continue to go up, and I've got a repo rate at 6%. And so you're going to see that pressure. But think about it from a market's perspective, right? If you are confident, if you're sitting as an asset manager, a fund manager, and you're confident that this is going to be more or less the inflation trajectory, it doesn't have to be exactly, it has to be more or less that you're going to get this base effect and that you're going to be talking about interest rate cuts. You don't want to wait for all of that to happen and then decide to go into the markets, because by the time you get to that base effect and the central banks are cutting interest rates, markets have already rallied because they are looking at the next economic cycle. So you can see how you, in the midst of this economic cycle, you're waiting for the economy, the data to get worse. But fund managers are thinking, okay, we're going to get a rollover, we're going to get a base effect in inflation. Interest rates eventually will be cut, and we want to be in the markets when all of that's happening. So they're looking to go into the market. They don't want to be too early, obviously, and they don't want to be too late. And it sounds bizarre because we're only really getting going with interest rates. Look at my interest rate forecast. We've got a long way to go in terms of interest rates. Same in other countries, same in the US. But asset managers are looking to move in. You don't want to be too early with this. Many fund managers would say, well, I'll give up the first couple of percent. I don't have to be the first in. I'm willing to give up a few percent before I'm assured or more confident that we're at the point of maximum pessimism. Others want to be in really early. It depends on the style of the fund manager. But what I'm trying to highlight is that while I'm presenting a huge number of negatives here, in the background, fund managers are looking at when they invest, not when they disinvest. The time to disinvest is gone. Hope that makes some sense. It's quite key. All right, so where's the dessert? Let's end with the dessert. What's the positives? And if you say that I'm scratching here for positives, I can't defend that. I am scratching for positives, but I need some. 4 things I want to highlight. First, we seem to have got COVID under control. Now, that might not sound surprising if you're living in South Africa, but if you're outside of South Africa, this is a standout feature, right? If you're in Asia, this is not the case. If you're in China, they've had these severe lockdowns and they've had another flare up and they might have more lockdowns. So that's not the case. If you look at the UK, they've had a resurgence of infections. So far, so good. South Africa's fifth wave was not really it was a fifth wave technically, but it hardly amounted to anything. Deaths have been brought under control. Hospitals don't have a problem in terms of COVID, and the numbers look okay. And we've kind of given up on vaccinations. If you look at how many people are vaccinated on a daily basis, it's dwindled. So let's hope that holds. Of course, we've got to be vigilant, and we'll continue to monitor this stuff because you can have a different variant that comes along and it changes this dynamic. But for the moment, it's a positive. We've lifted all restrictions. We'll start to see more entertainment, more sporting activity. Hopefully, we can keep this under control. It's critical that we do. Somebody's asking for Prozac. This is the Prozac. This is the Prozac. This is the dessert. But it looks better in terms of COVID. And I think that is an uplift as we go into next year. The second positive, government revenue is good. Government revenue is good. Government revenue, it's only the first 2 months of the year, but it's ahead of budget, quite a well ahead of budget. Government is sitting on a significant amount of cash. I mean, I say government, National Treasury. The tax revenue overrun last year was compelling. It's continued on this year. We don't think it's going to suddenly dwindle. Yes, commodity prices are coming off, but we think that there is at least some residual effect that will help. Government is on the whole controlling their expenditure. Expenditure at the moment is below budget. Yes, they've got some pressure points. The social grants are a pressure point. The salaries are going to be a massive pressure point. But in terms of cash flow, in terms of bond issuance, it's actually fine. The government can actually scale back bond issuance later on this year. They've got that much cash. Of course, what you don't want is for them to go on a massive spending spree, and I don't think the Minister of Finance intends to do that. But it's definitely a net gain. And it's something that investors will be increasingly aware of. And I think when we release the October medium-term budget, it will become clearer the favorable position that government is sitting on in terms of their cash flow. Now, that doesn't mean that we don't have a debt problem. We still have a debt problem. So government can't go on a massive spending spree and take on a huge amount of debt. But in terms of short-term improvement, this is meaningful. The third thing is that's all been recognized by the rating agencies. Yes, we're well below investment grade. Yes, it's going to take us a considerable number of years to get back to investment grade. But if you listen to the reports coming from rating agencies, they're acknowledging that there are improvements. They're acknowledging that the revenue looks better, that government has the right intention. They're not about to upgrade us. We're going to have to demonstrate that we're able to sustain this fiscal improvement, and we're going to have to lift economic growth. Rating agencies are flagging that the income inequality is problematic, the risk of social unrest, social fallout is significant. So they're not about to upgrade us, not at all. But we forget not long ago, we were in this perpetual downgrade cycle. And so I think we're not going to get downgraded anymore. That's pretty much gone. Most of them now has us on either a stable outlook or a positive outlook. And I think the next step is an upgrade at some point. As I say, I don't think it's quite there yet, but I think we're getting to that point. I think I did something to my presentation there. Sorry. Stop share there. Something went wrong there in my quest to explain stuff. Okay, hopefully you can see that now. So I think the rating situation is better for us, and I think that's net a positive. The last positive is we should start to see this uplift in tourism. Now, this is the number of people visiting South Africa on a monthly basis that stay overnight at least one night. So think of this as foreign tourism. People arrive and they book at least one night stay in this country. Obviously, many stay a lot longer. And you can see the typical number that we get on a monthly basis, and you can see that there's a seasonality, and then you can see how tourism plunged during COVID. But right at the end, the chart is recovering. It's not recovered. We've got a long way to go, but hopefully we see more recovery over the coming months and into next year. And I'm confident that we're going to see the tourism sector rebound meaningfully, especially since we've got no COVID restrictions, and hopefully that message gets out there. So there are a couple of positives that are going to start to help us. Are they enough? No. Are they going to change the game? No. Ultimately, though, South Africa needs to make huge strides in terms of dealing with this electricity crisis, first and foremost, instilling confidence that we're going to do something and get the electricity under control, even if it takes us another 2 years. We've at least got a much clearer plan, a much more convincing plan to do that. The second is we need a lot more policy implementation and a lot more focus on which areas are we moving forward on. Do I think we're going to have a lot of that before the ANC elective conference? Probably not. I suspect this is going to be a focus for the second term, if you like, of the president. In other words, once the elective conference is out of the way, I think you're going to have a focus in South Africa saying, okay, so the president has a second term. Is he going to use that second term wisely in order to make a real difference to this country? And you hope so. So I think we are in a bit of a political malaise at the moment. I think it is going to be a bit depressing. I think interest rates keep going up. The economy grinds weaker. But I think we've got to just focus on a couple of things. There are investment opportunities that fund managers are looking for. They want to invest at the point of maximum pessimism. The second thing is I think that we've got to look at the plans that government starts to put forward. Is there that urgency? And hopefully that starts to manifest now, finally, that we can get a little bit more encouraged by some of those dynamics. And then the final thing is we've got to recognize that we're going to go into another cycle, that inflation will come down around the world, interest rates will come down, and that will present South Africa with another growth opportunity. And hopefully we're in better shape to take advantage of that. So I'm not in any way suggesting this isn't a tough environment. This is incredibly tough. This is difficult messages to absorb. I think we've got to face up to our reality in this country. It's a tough reality. I don't think it's going to get better anytime soon, but hopefully we start to understand at a government level why this can't perpetuate. So that's more or less all from my side. I hope that makes some sense. A lot of questions. Let's have a look if we can answer some of those questions. The slides are going to be available quite quickly. I don't know exactly when, but within, I guess, days, they'll be available. A lot of questions about government policy. Yep, government has to do way more than they're doing now. That's extremely clear. The recording will be available. Oh, there's a question about gold. Good question. Why is gold not ready? I don't know the answer. We were looking at it this week. I don't know the answer. Gold has failed many tests. Eh? So we keep thinking, especially in South Africa, we have this love affair with gold, and every news bulletin they tell us the gold price. I don't know why, but anyway, they do. But gold just, it hasn't lived up to that expectation. It's just not the safe haven. We keep thinking that gold will be this phenomenal safe haven. And I think the rest of the world doesn't have that same thought around gold. So the gold price is actually weakened together with other commodity prices. And I think it's just because it's been treated increasingly more like just another metal. There's still, I guess, an element of safe haven about it, but it's not responding that way. The dollar is the safe haven asset. And it's the premier asset, rightly or wrongly. So gold's not enjoying that. And I don't think suddenly there's going to be this clamor for gold. To be fair, also, you know, the cryptocurrencies were put forward as also a safe haven. There were people saying, oh, this is an alternative. This is a safe haven asset. That's clearly not the case. So it's only really the dollar, even the yen. There was a time when the Japanese yen was safe haven, Swiss franc safe haven. At this stage, it's pretty much the US dollar. Yeah. There's a question about, are they reporting COVID the same as it was before? That's key. I don't think so. I don't think we're testing anywhere as much. Around the world, many countries have stopped reporting COVID, so it's not as easy to do that analysis as you want. And so the data, the quality of the data has deteriorated quite considerably. And I think in South Africa, you're getting an element of that that's coming through. So can we trust that data? No. But we are looking at the hospital numbers and we are looking at the death rate. And I think that data is better. And we still don't see a problem on that side. So even if the COVID testing is not as good as it once, I think we still got a sense that COVID is under control in South Africa. Bond yields are screaming a buy. Yeah, so there's value in bonds, right? And I mean, if you can get a running yield of 10% with a currency that's as weak as it is, our currency is significantly undervalued at 17, massively undervalued. So for foreigners, that would be a very welcome buying opportunity. The problem is going to be the same thing. Is this the point of maximum pessimism? In other words, is there more damage that's going to be incurred because of interest rate hikes? Is inflation rolling over yet? Could inflation go even higher? So there are a couple of key question marks in the very short term. But yeah, same as our equity valuations. If you're willing to look further out, there's lots of value, especially since government finances has actually been managed okay at this stage. Bizarrely, it's okay. So yes, there is value there. The question is timing. All of this is timing. And you want to find that point of maximum pessimism. And then you want to go into these markets. So yeah, there are some fund managers looking at the bond market. Could the turnaround on the base effects of inflation result in deflation? Yeah, it's possible in some countries. I don't think in the US. I think because in the US, the inflation rate is very broad now. So even if you got these base effects and you get some of those elements going negative, there are too many components that are high. So look at wages in the US, they're rising at 6%. That's not an environment where you get a base effect. So, I mean, not a base effect, a deflationary effect. So my view is not in the US. In other countries, you could start to have a discussion around deflation further out. It's entirely feasible. In order to gauge that, though, you've got to gauge what's happening to wages. And in many countries, wages are starting to ratchet up. So that's why central banks are going to fight this. I think I've gone way over time. I apologize. There's a question, what is your take on crime levels? Crime levels feel like they've got worse. I think maybe the media is highlighting it even more. There seems to be an extra focus on fighting crime and violent crime, but it feels to me that crime is problematic. And you throw in a couple of things. One is service delivery protests. You throw in political turmoil, more political assassinations in KwaZulu-Natal, the lead up to the elective conference. So, and then you throw in the high unemployment rate, all of those things. This is not a great environment in terms of the social dynamic. And I think the police are under enormous pressure, but have they got the structures? Have they got the manpower? Have they got the skills base to respond effectively? So far, I would say they need to do a hell of a lot more. I think that pressure will remain in place and hopefully they make some improvements, but yeah, it all feeds into this lack of confidence and undermining South Africa's broader economy. Is household wealth calculated over SA population or include it's calculated over the entire population? Because that's what you want to know. You don't want to just focus on a few people that are employed and saying, oh, those people have some money. You look at the entire population. And so the country's poor, South Africa's poor. And it matters because if you've got a business, you need a consumer base. And if people are not employed and they don't have wealth, very difficult. The market becomes incredibly small. For some products in South Africa, the market is unbelievably minute. Even though we've got a population of 50, 60 million people, our market's very small in some instances. Okay, so I think that's all from my side. Thanks a lot. Thanks for listening. Hope it makes some sense. Sorry for the interruptions and questions along the way, but some great questions, actually some brilliant questions. Sorry, I can't get to all of them. The presentation will be available, recording available Please have a look at our upcoming webinars. There's a great webinar planned from JP Morgan that's going to focus on some of the offshore investments. I think that's key to look at. Obviously, a lot of people have constantly been externalizing funds, and that's understandable. So please have a look at that. There's other webinars planned, and then we'll be back. We do this once a quarter. We'll see you next time. Thanks a lot, guys.